Have you ever found yourself in this predicament? Picture this. You enter a trade with utmost confidence and diligently set your stop loss at the recent swing low, for you vow not to remain in a trade if the price plunges below that threshold. However, fate has its way, and the price indeed drops, a bit slightly, below that swing low, but lo and behold, it swiftly reverses its course, aligning perfectly with your original intuition. Alas, you find yourself devoid of the profits that could have been yours. It is a disheartening experience, to say the least, but fear not, for I bring forth the solution to this dilemma. Today, in the realm of this video, I shall reveal to you my most cherished indicator technique on the renowned TradingView platform. This technique not only steers you clear of perilous stop-loss levels, it also empowers you to scale your stop-loss and extract the utmost profit from the market. Now, let me clarify that I am not referring to the conventional ATR indicator. You see, this indicator employs diverse calculation methods that transcend the utilization of mere ATR values in the market. However, do not despair. I shall also shed light on some ATR hacks that new traders ought to be well versed in. Thus, I implore you to remain steadfast until the conclusion of this video if you truly yearn to embark upon a profitable journey in the market. Now, my fellow traders, I invite you to navigate to the esteemed platform known as TradingView. Once there, kindly direct your attention to the Indicators tab and gracefully type in the acronym ATR. Its purpose, you see, is to meticulously examine the historical candles and ascertain the average volatility or magnitude of said candles. Look closely, for right before your eyes, you shall witness the display of the average candle size, a valuable piece of information indeed. Now, let us delve into the technique that shall revolutionize your stop-loss placements. First, take note of the price level where your original stop-loss was to be positioned. Take a moment to subtract this figure from the amount bestowed upon us by the ATR. Behold, this resulting number shall serve as the foundation for your new stop-loss placement. By incorporating the element of volatility and the average movement of prices, you shall find yourself exiting trades with grace and minimal burden. However, my dear friends, allow me to highlight a predicament that arises. Alas, the multiples of ATR values required may vary, for each trading pair possesses its own unique volatility within the market. To address this concern and ensure a steadfast stop-loss placement, let us combine the recent swing highs or lows in the market with our trusty ATR. Bid farewell to the ATR indicator itself, as there is no need for the laborious task of manual calculation. Instead, embrace this alternative method I present to you. Whether your intention is to embark upon a long or short position, take heed, for your predetermined stop-loss levels shall gracefully manifest on the screen even before the trading signals are triggered. And here's the delightful part. You possess the power to adjust the settings to accommodate any multiples of ATR for your stop-loss quotations. Furthermore, let us not overlook the sheer brilliance that lies within allowing the utilization of ATR values in decimal form. Imagine, if you will, the desire to set your stop-loss at precisely 1/8 times the value bestowed upon us by the ATR. Fear not, for it is an effortless endeavor to implement any number or fraction of your choosing. So I implore you, dear traders, to proceed forthwith and introduce the ATR stop-loss finder by Verifit. Traders, there are moments we find ourselves witnessing a decline in our ATR values due to the sweeping nature of market liquidity. However, fear not, for I shall now unveil the finest method of applying stop-loss. Join me as we navigate to the settings and make a simple adjustment to the ATR values, reducing them to a mere 0.5. This adjustment signifies our decision to utilize half the value of the ATR, a strategic move indeed. Now, envision a scenario where a signal prompts us to embark upon a long position, indicated by this particular candlestick. Should we proceed with this trade, our first task is to identify the recent swing low. There it is, residing at this precise level. Herein lies the crux of our approach. Instead of placing our stop-loss at the mere recent swing low, we shall position it at the ATR of said swing low. By implementing this methodology, we shield ourselves from the ominous liquidity sweep that lurks within the market. Observe closely, my friends. If we were to rely solely on the recent swing low for this particular market, the menacing wick of this candlestick would have rudely ejected us from this very market. However, By employing the ATR of the recent swing low, we skillfully evade the aforementioned liquidity sweep, thus allowing the market to move in our favor. Take note, for this method of applying our stop-loss levels successfully avoids a staggering 85% of market liquidity sweeps. I implore you, dear friends, to embrace this technique wholeheartedly and exercise utmost diligence in utilizing your stop-loss levels in this manner, thus liberating yourselves from the clutches of unhealthy stop-loss placements. Now, setting aside all other matters, allow me to illuminate the art of trade management and risk adjustment within the market. I proudly introduce to you this remarkable tool before us. Those of you who have been faithful viewers of my videos may have noticed my utilization of this indicator on multiple occasions. Please understand that the levels you see displayed on the screen are not indicative of buy or sell positions, but rather the stop-loss levels we must employ. Imagine, if you will, a scenario where we embark upon a long trade at this juncture. In such a case, we would diligently trail our stop-loss by utilizing this very indicator. And likewise, should we engage in a short trade, we would meticulously trail our stop-loss until we reach this point. To proceed, I urge you to add the chandelier stop by pip Charlie to your chart. Fear not, for you have the power to modify the settings of this indicator to better suit your needs in managing trades within the market. By default, the chandelier stop manifests itself as a bold blue and purple line that gracefully overlays the price chart. Allow me to decipher its significance for you. The purple line represents the stop level for a short position, while the blue line signifies the stop level for a long position. You see, the chandelier stop derives its calculations from the average true range, rendering it independent from the inherent volatility of the instruments at play. Now, I understand that for some, utilizing this indicator to trail your stop-loss may appear daunting and time-consuming. The need to make significant adjustments whenever the indicator provides a new trailing point can be quite burdensome. Hence, I offer an alternative approach, should you find the aforementioned method too arduous. Please, if you are enjoying our videos, don't forget to smash the like button and subscribe to the channel, as it motivates us on the hunt for the Holy Grail. Moving on. To provide a more comprehensive understanding of the forthcoming revelation, let us delve into a trading strategy situated within a lower time frame, such as the esteemed 30-minute time frame. For the sake of illustration, let us assume the existence of a meticulously crafted strategy, which we shall aptly christen the 100 moving average strategy. This strategy holds such promise that we opt to initiate trades when the price action gracefully crosses the moving average. In this scenario, allow me to present a hypothetical situation where the price deftly descends beneath the moving average, prompting us to embark upon a short trade. With our trade now open and underway, you may observe the indicator adorning the market with its zigzag lines. And it is within this context that we shall unveil the proper management of your stop-loss in the market, employing the aid of this very indicator. Given that we find ourselves in a short position, our approach entails adjusting our stop-loss level whenever the indicator manifests new downward slope line, elegantly painted in a resolute shade of red. Conversely, when engaging in a long trade, we harmoniously align ourselves with the green upward slope lines that emanate from the indicator. Let us now envision a scenario where we have obtained a valid entry at this precise juncture, with our recent swing low situated at this specific level, while our steadfast stop-loss level steadfastly maintains its position. At this juncture, our next course of action entails patiently awaiting the appearance of the zigzag line, which will gracefully imprint upon the chart a strikingly labeled red line. Lo and behold, our keen observation rewards us with the sight of the very first labeled line upon the chart. In this moment, we must be cognizant of a fundamental principle. For every downward slope, an upward slope is anticipated to follow suit. Bearing this in mind, we embark upon a pivotal task. We proceed to remove 50% of our stop-loss from this trade, thereby deftly adjusting our stop-loss level. Now, we must patiently await the unfolding of the bearish trend, and should, by some fortuitous occurrence, our bearish retracement conclude its movement without breaching the newly established stop-loss, we must proceed with scaling our stop-loss levels, safeguarding our market gains until such time that we are genuinely halted by the ebbs and flows of price action. Observe, my friends, as the completion of our bearish retracement manifests itself, gracefully accompanied by the appearance of an upward slope line upon the chart. At this precise juncture, we hold the expectation that the price shall persist in its downward trajectory. To proceed, we patiently await the arrival of the subsequent red downward slope from the zigzag before undertaking any further action concerning the adjustment of our stop loss. Behold, for another downward slope has been imprinted upon the canvas of the chart. Consequently, we now diligently adjust our stop loss, situating it at the highs of the last zigzag's downward red slope line. Observe how this last red downward slope line materialized at the culmination of this candlestick. Accordingly, we promptly align our stop loss with the highs of said candlestick, awaiting the completion of the ensuing bearish retracement before resuming the scaling of our stop loss level. Note with discernment, dear comrades, the conclusion of this bearish retracement, all the while acutely aware that the subsequent market movement shall manifest as a downward slope. Henceforth, we remain posed, patiently awaiting the completion of said downward slope before making any adjustments to our stop loss level. Once more, behold the completion of this downward slope, prompting our decisive action. We now position our stop loss level at this precise point. Take heed of the fact that this indicator adeptly identifies the lower lows and lower highs within the market, and we are well aware that should the market breach the recent lower high, a change in its directional momentum becomes increasingly probable, signaling an impending upward wave. Through the adept implementation of this application methodology, we ascertain that our scaling of the stop loss persists until we reach this culminating point, wherein we are gracefully halted. Within the market, take note, my friends, that this final downward slope takes on the peculiar characteristic of an ash-like demeanor. When confronted with such a slope line, I find it prudent to utilize half the magnitude of the previous downward slope, thereby affording ample space for a substantive bearish retracement. Ladies and gentlemen, as you can discern from this trade, we enter the market at this precise juncture, proceeding to adroitly scale down to approximately this position. I implore you, ensure that you diligently employ this strategy, for it holds the key to unlocking profitability within your trading endeavors. And thus concludes our discourse for today. My esteemed viewers, I extend my gratitude for your attentive viewership and eagerly anticipate our forthcoming encounter. Until then, farewell.